On the 30th of October, Rachel Reeves will deliver Labour's first budget. With a big majority and an election mandate for change, we can expect some significant increases in tax and changes to the status quo. I cannot recall a budget that has been surrounded by so much fear and speculation, which has largely been caused by Labour themselves, with their persistent messaging about how dire a state government finances are in. But also because of the media's relentless, often baseless speculation about what changes might be implemented. From potential increases to capital gains tax, inheritance tax, to limits on ISAs and radical changes to pension tax relief and tax-free cash. As a YouTuber and a financial advisor, I see firsthand the stress and confusion this messaging is causing, both in terms of the comments that I'm getting on YouTube and in the conversations that I'm having with my clients. The key questions being, what changes are actually likely to happen? And if so, are there any actions that I should be taking today to protect myself? Of course, at this point, no one, not even Labour themselves, seem to know what they are going to do. And I'm conscious that I don't want to add to that speculation. But at the same time, I have seen so many bad takes and unhelpful suggestions that seem to be causing unnecessary stress and could lead people to make poor financial decisions. So in this video, I'm going to address these questions by looking at what the government has actually said and what is pure speculation, what changes may be introduced, and importantly, when. If Rachel Reeves announces a bunch of changes on the 30th of October, but they don't come into effect until the start of the next tax year, then clearly engaging in speculation now as to what those changes might be is a pointless exercise that is only likely to get you riled up by a bunch of far-fetched ideas that are never likely to come to pass. Yes, taxes are likely to rise, but if you can't do anything about it now, you're better off shutting out the noise, waiting for the actual changes to be announced, and then updating your plans when you know what the new rules are. If, however, changes do come into effect immediately, then there may be actions that you can take today to protect yourself. Perhaps by triggering a capital gain whilst rates remain low, or making a pension contribution before tax relief changes. This is why I think the potential timing of these changes is so important, and in my opinion, it's much easier to guess the timing than what the specific details will be. So, how have we got here? Rachel Reeves has laid the foundations for tax rises by declaring that there is a £22 billion black hole in the government's finances that she needs to fill. At the same time, the government has repeatedly confirmed their pledge not to increase income tax, VAT, or national insurance contributions, with the key message that Labour will not raise taxes on working people, and that those with the broadest shoulders should bear the biggest burden. This has led to speculation that the government is focusing on raising capital gains tax, inheritance tax, or making changes to pensions and perhaps even ISAs. So let's start with ISAs. The media have been continually regurgitating this notion that Labour could be considering putting a £100,000 cap on ISA savings. However, this is pure speculation on the back of a report by a think tank, the Resolution Foundation, who seem to think this could be a good idea. Yet, the only comments that the government themselves have made about ISAs is that they're keen to simplify them. So it would be very strange for them to implement a change like this, not only because it would add huge amounts of complexity, as they would likely need to introduce transitional protection for those that are already at or over these limits, but it would also seem like a double-fronted attack on investors, given that it's already clear that the government is keen to make changes to the capital gains tax regime, which we'll discuss now. At the moment, basic rate taxpayers pay 10% tax on capital gains and 18% when selling a property, whilst higher and additional rate taxpayers pay 20% and 24% on property. On the face of it, these rates are pretty much the lowest they have been since CGT was first introduced in 1965. In the past, there have been flat rates of CGT as high as 40%, or they have been aligned with income tax bands, which have been as high as 65%. Compared with today, these rates sound huge, but there was one big difference. The problem with the way that capital gains tax currently works is that you can find yourself paying tax even if you've not made a gain. Let me explain. Over the past 5 years, the average UK house price has risen by just over 20%. So let's say that back in 2019, you bought a buy-to-let flat for £100,000 and you sold it today for £120,000, you'd have made a £20,000 gain. £17,000 of this would fall outside of your capital gains tax allowance, and if you're a high rate taxpayer, you would have £4,080 of tax to pay. However, Over the last 5 years, inflation has risen much faster than property prices. So in real terms, you've actually made a loss over this period, and yet you're still having to pay tax, which pushes you into even more of a loss. Now let's think of this in terms of the stock market. We don't know what returns the stock market will deliver in the future, but for the sake of this example, let's assume it's similar to the past, and that you invest in a global index fund that delivers an average return of 9% per year. And let's assume that you have fund and platform fees of 0.5%. If inflation averages 3.5%, you'll be left with a 5% return after accounting for inflation. But if you're a higher rate taxpayer, you'd have to pay 20% capital gains tax on your 9% return, which then reduces your real return by 36% to 3.2%. If, however, capital gains tax rose to 40%, it would reduce your real return by 72%. And if it rises to 45%, it will reduce your return by 82%. At this point, it's hard to see why you would bother investing at all. You're taking all of this risk with your money, with no guarantee of seeing a positive return, and even if you do, you'll lose the majority of those gains to taxes. This demonstrates why even small increases in capital gains tax can quickly disincentivize people from investing. This is why, in the past, when capital gains tax rates were higher, there has typically also been some sort of indexation relief. This has taken several different forms, but the main idea is that you then only pay tax on your gains after taking inflation into account. So on one hand, it seems like capital gains tax is likely to rise, which may suggest that you'll be better off realizing gains now whilst rates remain low. But on the other hand, if the government increases rates but brings back in some sort of indexation relief, as in our house price example, you might actually be better off under a new system. So the key question is, when might these changes come into effect? If it is a simple change, like increasing the headline rate to 30% without any indexation relief, it could be implemented immediately, as it was when George Osborne last raised CGT rates back in 2010. But if the changes are more complex, it is highly likely that they will come into effect from the start of the next tax year. The other reason that the government may choose to delay is that it would trigger lots of people to sell or rebase their assets before April to take advantage of lower CGT rates whilst they last, which would provide the government with a short-term tax revenue boost. So I hope you can see that even if CGT rates do rise, realizing a gain before the 30th of October may not necessarily be a good thing. Although, if you really wanted to hedge your bets, you could try and take advantage of the bed and breakfasting rules, which stipulates that if you sell an asset and then buy it back again within 30 days, from a CGT perspective, it's as if the asset was never sold. As an example, let's say that you sold a fund or a stock on the 25th of October and realized a gain. Then, if in the budget CGT rates don't go up or some other changes are introduced that mean that you no longer want to crystallize that gain, if you buy back the same fund within 30 days, the original sale would not count. This is a highly simplified example, and I don't have time to go into the pros and cons of this strategy in detail. So I've left some links in the description if you're interested in reading more about this strategy. Clearly, these are highly nuanced decisions. So if you are thinking about selling something before the budget, I suggest that you speak with an accountant. They won't be able to advise you based on budgetary speculation, but they will be able to help you understand the personal factors that you need to consider before making a decision. As an alternative, or perhaps in addition to raising CGT rates, the government could remove certain CGT reliefs, such as business asset disposal relief, which allows business owners selling their businesses to benefit from the lowest CGT rate of 10% on the first £1 million of chargeable gains. Deciding to sell or wind down a business is not a decision that should be made quickly. So unless you're already a long way into this process and can try and expedite it before the budget, there's not much that you can do to protect yourself from a change here. Now, on to pensions. Given that Labour have ruled out increases to income tax, national insurance, and VAT, which are the three big tax revenue generators, there has been a lot of speculation that Labour could be looking to make changes to pensions, which could easily raise a lot of tax. The two potential changes getting the most airtime are the introduction of a flat rate of income tax relief, or the removal or reduction of the amount of tax-free cash that you can draw from a pension in retirement. In the past, Rachel Reeves has argued in favour of introducing a flat rate of 33% income tax relief on pension contributions, which would make pension contributions much more attractive for baby basic rate taxpayers and less attractive for higher and additional rate taxpayers. If a change like this is introduced immediately, higher rate taxpayers could be better off making pension contributions before the budget, and basic rate taxpayers could be better off waiting. However, not only has Labour insisted that having a flat rate of income tax relief is no longer their stance, nor Reeves's current view, but a change like this would represent a massive upheaval. It would be very hard to implement and could disincentivise pension saving because people could easily end up paying more tax on pension withdrawals than the tax relief that they get when going in. Of course, we can't rule out any changes, but if we do see one, I think it is highly unlikely, if not impossible, that this would be implemented immediately. But I could be wrong. And if you're a higher rate taxpayer, you might be sitting there thinking, well, tax relief is hardly likely to go up for me. So what's the downside of making a pension contribution now? I agree that if you are already planning on making a pension contribution later on in the year, there could be an argument to bring that forward. However, the challenge of making a contribution now, when you're halfway through the tax year, is that you don't know what your taxable income will be for the year. So you need to be careful that you don't end up over-contributing or getting less tax relief than you thought. And of course, if you do think that pensions are in the government spotlight, you're also running the risk that they introduce other changes that make you regret making that contribution. As an example, there is also speculation that the government could reduce or remove the amount of tax-free cash you can draw from a pension. Currently, this is set at 25% of its value, up to a maximum lifetime limit of £268,275. As a result, I have seen some people suggesting that retirees should withdraw all of the tax-free cash from their pensions whilst they still can. However, again, this is all just speculation. As far as I'm aware, this is not based on anything that Labour have said. In fact, before the election, Labour said that they were committed not to make any changes to pension rules in the short term, to give us some continuity because there have been a lot of changes recently. Whilst in their manifesto, they only committed to undertake a review of the pension landscape, which again suggests that they have no immediate plans to make changes. Of course, Rachel Reeves could use the recently discovered black hole as an excuse to change her stance. But again, I think it's highly unlikely that any changes would be brought in immediately. Just think about the chaos that will be caused if they reduce tax-free cash overnight. Not only for people that are already in retirement, but also those near it. There will be people out there who have literally just handed in their notice and retired based on their belief that this benefit will be available to them. This is why I expect any changes to be well telegraphed, giving people plenty of time to digest them and adjust their plans. And if the changes do negatively affect those at or near retirement, they would probably introduce a transitional period or protections so that these people retain their rights, just as they have done in the past with prior tax changes to tax-free cash and pension access age. Don't get me wrong, I am not saying that Labour won't make any changes to pensions. Every government has changed pensions in some way or another. Just that I highly doubt that these changes are going to come into effect immediately, which is again why I think we'll be in a much better position to make good financial decisions after the 30th of October when we have the details of any changes in our hands. The area that I think may see more immediate change is pension death benefits. Currently, pensions fall outside of your estate for inheritance tax purposes. So if you have a defined contribution pension and you die before the age of 75, your beneficiaries can inherit that as a tax-free lump sum. And if you die after the age of 75, they inherit it, but they have to pay marginal rate of income tax on withdrawals. These benefits are so good that many wealthier people now see their pension not as a vehicle to provide them with income in retirement, but as one to pass on wealth to future generations. So I think there is a high chance that we could see the pre-75 benefits removed or pensions brought into the scope of inheritance tax. Either way, I don't see much point in speculating about these types of changes because you can't do anything about them anyway, so we'll just have to wait and see. On the subject of inheritance tax, there have also been rumours that Labour could increase the IHT rate beyond 40%, create a lifetime allowance for gifting, or even abolish IHT altogether, instead replacing it with a capital gains tax charge on death. However, again, this is all just speculation. Labour have previously said that they have no plans to change IHT, but of course, that is not a promise that they won't. What they did say is that they might close or reduce IHT exemptions for farmland and businesses, as currently it's possible to pass certain trading businesses and farmland onto beneficiaries without paying IHT. Labour did not clarify this point in their manifesto, but we do know that this is an area that they are actually looking at. What was included in their manifesto was a pledge to end the use of offshore trusts to avoid inheritance tax as part of abolishing the non-dom tax regime. Although the Financial Times has just reported that Rachel Reeves is considering a U-turn on this, off the back of advice that this would push wealthy people away from the UK and would not deliver the tax windfall that she was hoping for. This is just another classic example of why trying to make speculative financial decisions before you've actually seen the legislation is like trying to build a house on top of shifting sands. The only way that you can reliably get around IHT is by spending your money or giving it away. I think that if changes to gifting rules are made, they could be brought in immediately. So making a gift before the 30th of October could be beneficial. However, these are not the types of decisions that should be rushed, and a premature gift can cause more harm than good. So unless you've already planned on making a gift, I think it's best to wait, think it through properly, and see what changes are introduced. To conclude, I think that speculating about what changes may or may not be in this budget is largely a complete waste of time, as I think it's highly likely that most of these changes will not come into effect until the new tax year in April 2025. Which is why, in the meantime, I suggest blocking out the noise, waiting for the new rules to be announced, and then updating your plans only when you have the new information to hand. But of course, I could be wrong. So if you already have plans to make a pension contribution, sell an asset, or make a gift at some point later on in the tax year, there may be an argument to try and bring that forwards before the budget. As I have laid out, these are highly personal decisions with lots of factors to consider. So please seek advice if you're uncertain. And this is a reminder that if you are looking for help with your finances, the only way that you can get in touch with me and my team is through the link in the description of the video. There are lots of bots in the comments section pretending to be me. So please remember that I will never contact you directly, whether that's in the comments section on LinkedIn, Instagram, or Facebook. Good luck blocking out the noise, and I'll see you in the next one.